Hi everyone, and welcome to the Squirrel Investor webinar. Today we're focused on understanding credit risk. This is going to feel a little bit like you're a credit manager going into your first ever lecture. We'll call it Credit Risk 101. Anyone want to sign off now? Maybe, maybe not. I've got what I believe is some great content for you. Some of it gets a little deep, but bear with me and I'll try and bring it together and summarize the information as we go. Gotta love a good disclosure statement. If you want to read that in full, I'll let you go back and see that in the webinar notes and in the recording. So feel free to read that in the future and I won't bore you with it too much right now. Okay. So our agenda today, I'm going to split the information into two parts. So first of all is understanding credit risk for mortgages, residential mortgages that is. And then secondly, how Squirrel manages that investment risk or that credit risk for you, which is your primary risk when you're investing with us. Once we get to the end, we'll move into Q&A. You can ask me anything during the course of that. All right, kicking into gear, the investment risk spectrum. I suspect this is somewhat familiar for many of you. So at the lower risk end, generally speaking, or lower risk and lower volatility end, you have debt type investments, which is what Squirrel offers. Walk up the ladder, you get next to property. So it could be residential, commercial, or industrial, where you own the property in some way, shape, or form. Keep going up that ladder, you get to equities, so it could be local share market, international shares, could be active, could be passive, and then you get to exotics. So what you tend to find is, generally speaking, lower risk and lower volatility at the left hand end of that spectrum, and a bit more risk and volatility at the right end of the spectrum. Just because debt, I've said, tends to be lower risk and lower volatility, not all risk is the same, or not all debt is the same. So if we walk through three of the most common ones, you've got government bonds. You could invest in the USA government bonds, or you could invest in Somalian government bonds. You can probably figure out which one's the lower risk of those two. Equally, if we look locally at bank deposits, you've got ANZ Bank, who have a AA- credit rating, and you've got SBS Bank, who've got a BBB rating. So quite a big difference in credit ratings across banks in New Zealand. In the bottom category, I've called it fixed interest, and it's a pretty wide-ranging group. You've got residential mortgages, which tend to be at the lower risk end of that spectrum. And then you've got things like Hanover Finance debentures. For those of you who lived through the GFC, you'll probably realize that Hanover Finance doesn't exist anymore. Their debentures were pretty high risk and they fell over and people lost a lot of money through that one. So everything's a spectrum when you're investing in debt, different types of debt, some of which will be lower risk and some of which will be higher risk. So you can actually quantify credit risk. All right, so for the boffins amongst you, here's how you would actually quantify it. So first of all, take what's the chances of a loss occurring. Okay, so you think of a portfolio of loans. How often might one default? That's what you're asking there. The second part of the equation, so loss given default. So if a loss does occur, how much are you likely to lose? Make sense? Multiply those two things together and that will give you your credit risk. We'll do a worked example in a moment. So what is credit risk? It's the chance a loan's going to go bad. If it does, how much might you lose? When you're investing in debt, then credit risk is the primary risk you typically face. There are other types of risks as well, and I'll cover those right at the end of the presentation. That formula gives you an estimated credit loss for a portfolio, and you can apply that formula to most types of debt. Most lenders will have a credit model that they're using to try and determine the amount of credit risk that they're taking in their portfolios and determine how much they need to reserve or provision in amongst what they do. So that gives you an idea of what this A, what the formula is, and then B, what it does. Okay, so we're going to now move into a worked example of how this kind of plays out in real life. All right, starting at the top. So let's take a single mortgage. Let's assume that you bought a house in Wellington for $1 million in October 2021. So at the peak of the property cycle, it was an interest-only loan for $800,000, which gives you a loan-to-value ratio of 80%. So that's the value of the loan divided back by the house value. Roll on 3 years to October 2024, and that loan has now defaulted. Okay, so they've stopped making their loan payments, and as the lender, you've moved to a mortgagee sale for the property. House prices have fallen 22.5%. This is trying to be a realistic example. House value is now $775,000, and that's what you get at mortgagee sale. So we know the loan value is $800,000, so you're already underwater at that point. You've also got some mortgagee sales costs. So you're going to have legal fees, probably some advertising fees, and maybe you needed to cut the grass and tidy up the gardens before you presented the house for sale. So let's assume that's $40,000 there, which gives you a $65,000 loss when you sell that property. That works out at a loss ratio, so that's the size of the loss divided back by the loan value of 8.1%. Okay, so that's a single mortgage example. Let's try and apply our formula to that now, which is the bottom half of this page. So you've got a portfolio of mortgages. We said figure out what the probability of loss is. So I'm going to use 0.02% here for this, which is 2 loans out of 10,000 that you will have a loss on. Makes sense? So that sounds like a really low number. Further on in the presentation, you'll see that actually that's not too bad an estimate based on the New Zealand and Australian markets looking back in time. The loss given default we worked out above the line was 8.1%. So we're going to multiply our 0.02% by 8.10%, which gets us to a credit risk of 0.16% on a portfolio of loans. So what does that translate to from a revenue outcome for the lender or the investor? So let's say the interest received from the borrower was 6%. The expected loss is 0.16% per annum, which means your net interest received is 5.84%. Okay, so we've experienced a couple of losses in this portfolio, let's say. You are going to lose a bit of your interest, but you haven't eaten into your principal. Okay, so you haven't eaten into the capital that you've outlaid. You've eaten some interest, but no capital loss, which is a good outcome. Okay, so let's have a look now at what write-off rates have occurred in the residential mortgage space in different parts of the world. Let's look at some severe recessions. So Australia, 2009 through 2012. So that's GFC period, right? You can't even see the line. There is a line there, but very hard to distinguish on the screen. And I'll show you that in a bit more detail on the next slide. UK, 2008 through 2012, so GFC period, there's about a 0.5% loss rate, 0.5% during that period. For Sweden, early 90s, for those of you who were kicking around in the early 90s, you'll know that was a pretty severe recession in many advanced economies at that point. So Sweden, they had losses of about 1.6, 1.7%. UK, early 90s as well, so that was pretty bad. That got almost to 3%. And then you've got Ireland, post-GFC, and I'll cover this in a case study in a little bit. They got to over 5% losses over that 3-year period, 2011 through 2013. I've also got the US in here through that GFC period. They suffered losses of around 7%, which is pretty high, in fact, extraordinarily high. I've painted the US in a different color. The reason being that the US market operates differently than the way the New Zealand and the other markets operate. In the US, you can literally just hand your keys back to the bank and say, there you go, that's your problem now, not my problem. You've effectively given the loan back to the bank at that point. The last point that I've got on this page is around tail risk. So tail risk is what happens when there's a severe disruption to the market or a severe recession. And you'll hear the Reserve Bank of New Zealand in their financial stability updates. If any of you ever want to tune into one of those, they happen twice a year, they talk about stress testing of banks. And what they're really trying to understand is what happens when things go really pear-shaped. So, for example, they'll stress test the banks at a 40% reduction in house prices, just as an example. So you can really get a sense of tail risk when you see house prices fall a long way, and there's a lot of modelling done to try and understand that by banks, and particularly reserve banks, because they want to understand what the systemic risks are of a lender falling over. Okay, hopefully not bamboozling you as we go. All right, promised an Ireland case study. So during that GFC period, they had a 10% loss rate, so probability of loss 10%. And when a loss occurred, it was eating 30% of the value of the loan. Okay, so that's a pretty severe scenario. So in order to plan for that, you needed a credit risk in that tail risk situation of 3%. Okay, so that's what you had to kind of plan for as a lender. Did they? No, unfortunately they didn't. So what else was going on during in Ireland during that period? So house prices, particularly in Dublin, had increased dramatically in the year or two prior to the GFC taking place. So they're up around 50%. About half of the new lending that was completed in that year or two pre-GFC was over 80% LVR. Okay, so that's pretty high risk lending. If you compare that to what happened in New Zealand during that period, there was less than 10% of new loans were done at over 80% LVR. In fact, there are examples in Ireland of loans being completed at 105% LVR. So what does that mean? That means the value of the property was estimated to be $1 million, and the bank lent them $1,050,000. Okay, so they lent them more than the value of the house, often to clean up some debt or consumer type debt and those sorts of things. So some very high risk LVR lending completed. Then we saw a 50% reduction in house prices and an unemployment rate that went to 14.5%. Okay, so a highly severe recession with some lending that you might consider pretty high risk on a loan to value ratio basis. And on top of that, Ireland had been building a heap of new houses. So they had a whole lot of stock on the market, not unlike what we have in the market here in New Zealand right now, where there's lots of housing supply or lots of new houses on the market waiting to be sold. But closer to home now, so what happened in Australia during the GFC? So if we start with the graph on the left, you can see mortgages right down at the bottom. So the maximum 1 year write-off that we saw on mortgages was 0.03% in 2010. The average write-off per annum was 0.02%, 2009 through 2015. On the graph, I've also shown personal loans and credit cards just to create perspective. So you can see those types of loans have much higher write-off rates, and often why they have higher interest rates for you as a borrower, if that makes sense. Right. Finally, let's get to New Zealand. So what do we know about the New Zealand residential market? So here's data from the Reserve Bank of New Zealand. It goes back to 2015. Unfortunately, it doesn't go back through the GFC period. I think we'd all say it would be lovely if I could take the series all the way back to, let's say, 2006 and follow through what happened during the GFC. Unfortunately, it doesn't. So this is what we've got, 9 years of history. So the mortgage market today is $360 billion. Okay, it's a pretty big lump, would be fair to say, given the size of our economy and in relative terms to what we see overseas. The banks are generating revenue. So in 2024 calendar year, using a 1.5% net interest margin of $5.4 billion in revenue. Okay, so it's not profit, it's their net interest margin of $5.4 billion in the year 2024. If we move to the graph on the right, this shows their net write-offs by year. Okay, so 2015, you can see there was $57 million written off. So this is kind of tail end of GFC. 2016, that dropped to 31 million. You can see the graph And 2024, which, we've been in recession for almost 2 years, you saw the banks wrote off about $15 million. So that was their loan losses on home loans during that period. Remember, they made 5.4 million on their home loan portfolios in net interest income, and they suffered write-offs of 15 million last year. So that's a pretty good equation. I think any financier would be pretty happy with that as an outcome. So what does that translate to in percentage terms? So peak write-off rate, 0.028%. So that's, let's say 3 loans in every 10,000 where there was a write-off. Pretty low. The average rate over that 9-year period is 0.007%. I had to go to 3 decimal places to make that one make sense. So broadly speaking, you would say, based on 9 years of history, New Zealand mortgage market has been a pretty safe place to be for the financiers. Reserve Bank has encouraged that through the use of loan to value ratio metrics with the banks. They can't write lots of loans over 80%. You'd have to say that's a good thing once you look back at that Ireland example. They've also more recently introduced debt to income ratios, which will mean that borrowers can't overextend themselves quite so easily. The other thing that they've done is they've also demanded that banks hold more capital. And if you pay attention to kind of business type headlines, you may well have seen commentary on that in the market where the banks are kicking up a bit of a stink about having to hold up to 16% of capital against their loan books. Really what we're seeing here is the Reserve Bank recognising that New Zealand residential mortgages are a very large lump and could cause systemic risk to our economy. So they're saying, banks, actually, we want you to be really quite safe and quite conservative in the lending that you make. Right, into section 1. Hopefully you've stayed with me and haven't fallen asleep at that point. Summary so far. So the number of loans that default is probably lower than what you might expect. I do wonder if I wandered down the street and said, out of a portfolio of loans, what percentage might default at any given time? Most people, particularly for residential mortgages, most people would probably say, actually, the number's higher than what the data actually tells us. The loan to value ratio that you lend at is really important to understand what type of losses and the size of losses that could eventuate when a loan defaults. Talked a bit about tail risk, really important, and that's something that all lenders worry about quite a lot. So what's the kind of some worst case scenarios that might happen, and how do you plan for that? We talked about the Reserve Bank. They're pretty tough in the way that they regulate banks in New Zealand, and they're trying to prevent tail risks occurring. Last but not least, the actual credit loss rate that's been experienced by New Zealand banks is actually quite low. If you look over the last 9 years, and you could say, well, over that period, actually, New Zealand economy's done pretty well, apart from the last couple of years. But what we haven't seen is large losses materialize from the banks. Okay. There's your summary. So let's start talking about then how Squirrel manages risk for you, our investors. To begin with, there are 3 layers of risk protection that we put in place. So first of all, before we lend money, we will assess the borrower and the project that they have underway and the reason for us to lend to them. So just like a bank does, we get the information from the borrower. We run credit checks, we make sure they can afford it, we do all those sorts of things to make sure that they're a worthy borrower. Second thing that we do is we'll take security. So in the case of our home loans and construction loan, term investments, and for our Squirrel Monthly Income Fund, all of the underlying loans will have a first mortgage in place. And we will lend an LVR, loan to value ratio, that's appropriate to the situation. So a higher risk loan, we might want to see a lower loan to value ratio, for example. On a lower risk loan, we might be prepared to go to a higher loan to value ratio. And remember that the maximum LVR that Squirrel will lend to for our first mortgage-backed lending is 80%, 80. Our portfolios on average run at around 60%. So, there tends to be quite a bit of borrower equity in there before the portfolio would suffer a loss on average. Third layer is Squirrel's reserve fund. So this is really what I would consider to be the shock absorber. So let's now talk a bit more about how the reserve funds work. So here's a working example. I've just made the numbers up, but they'll give you a sense of it. So the borrower is paying 8%, investors earn 6%, the reserve funds earn 0.3%, and Squirrel earns 1.7%. So if you think about that, over the course of the year, the borrower has paid 8% interest, investors have earned their 6%, reserve funds had money flowing into it each month when the borrower makes a payment, and Squirrel has earned a margin for us to manage the loans, manage the borrowers, and do all the things that we need to do to look after both you, the investor, and the borrower. When a loss eventuates, you see money move from the green acorn back to our investors. So the reserve funds are there to back our investors if any particular loan ends up with a loss. So the role of the reserve funds in a little bit more detail. If a borrower misses a payment, the reserve fund steps in and will make that payment to investors. When the borrower catches up on that payment, they owe that money back to the reserve fund, which helps recapitalize it at that point. If a loan happens to default, so let's say it's a first mortgage-backed loan, the borrower defaults, Squirrel will then initiate the procedure to go through mortgagee sale, as an example. While that's happening, investors continue to receive their interest paid for by the reserve fund. And then once the property is sold, we'll get the proceeds to hopefully cover the loan. If there is a loss at that point, then that money is returned to investors on a gross basis back to investors. So investors won't have lost any money, assuming the reserve fund is capable of making that payment back to them. All right. The reserve funds act as your diversification mechanism. So you get the benefit of the whole portfolio of loans, even though you may have invested in just one loan. In the case of investing in our term investments, the reserve funds help create that diversification mechanism for you. Okay, so you don't need to try and invest across lots of loans. Actually, it's the reserve fund that creates that diversification for you. You get the benefit of the whole portfolio of loans. The reserve fund money is not Squirrel's money. The money is held on trust for our active investors. And occasionally I get the question, well, what happens if you wind everything up? What happens to that reserve fund money? And the answer is, in the case where everything winds up, so let's say Squirrel winds up, stops lending, once all of the loans are repaid, if there's money left in those reserve funds, it goes to charity. And in fact, we've named a charity being the Starship Foundation. So that's where that money goes, should we wind everything up once all the loans are repaid. Squirrel doesn't guarantee the reserve funds. However, no investor's ever lost a cent investing with Squirrel, and partly because the reserve funds have done their job and the credit models that we're running are working for our investors. And I'll cover that in a little more detail as we go. Here's an example of the information you can find on our website about how the reserve funds are performing. So I've used our construction loans as an example. And as I said, all of this information is on our website. If you go to the Save and Invest menu and look at the View Performance page and scroll through that page, you'll see a wealth of information. We're really transparent in the way that this works. And I would say we're one of New Zealand's most transparent lenders, if not the most transparent around how this works. I've rounded these numbers. They were taken off our website yesterday, but I've rounded them just so you get a sense of it. So the active construction loan book is 178 million. So that's the balance of all the loans held in that particular pool of loans. The reserve fund is 3.1 million. Okay, so there's 3.1 million sitting in a bank account, ready to be deployed should losses come through in the portfolio or borrowers missing payments. We're reserving at 0.89% per annum on that portfolio. Okay, so you can work out what the inflow of money is into those reserve funds based on the active book. Our modelling suggests that the credit risk, or the expected credit risk in our portfolio, is 0.46%. That credit risk assumes tail risk, okay? So we're planning for tail risk. We've assumed house prices decline 30% from settlement value when we go into this and look at what we expect those loans, what we expect the credit risk is in that portfolio. Okay, so that's our expected tail risk. Our life-to-date default rate, so this is the default rate that we've actually experienced, is 0.05%. So that's 5 loans in every 10,000 that we write going bad. That's what we've experienced when you kind of work it through back to a percentage level. This is, and that's 3 loans. So life to date, we've had 3 loans default with a loss. You can also work out a credit risk ratio. So how much coverage does the reserve fund have based on the expected level of risk? So based on that 0.46% of risk, that ratio is 3.8%. Okay, so we've been pretty conservative in the way that we are reserving to make sure that we cover those expected credit risks should they eventuate. Here's our performance today. So if I go through each of the 3 main lending portfolios, so home loans, we've been running for 5 years. We've written 168 loans. We've had no defaults. So there is no default rate that I can even report to you. For our construction loans, we've been running for 6 years. We've written 800 loans. We've had 3 default, which gives us an actual default rate in dollar terms of 0.05%. Okay, so that's our experienced loss rate to date on those construction loans. Remember, we're modelling or expecting credit risk of 0.46%. We're reserving at 0.89%, and our actual rate that we've seen is 0.05%. Personal loans, running for 9 years, we've written 3,500 loans. We've seen 123 loans default for an actual default rate of 1.14%. Some people might say, well, wow, and that's a big jump up from the secured loans. Well, yes, and that's the nature of personal lending. There is a higher risk portfolio. And I think I showed you the Australian data earlier, which suggested that that was running at about 2.5% through that GFC period for Australia. So overall, that default rate at 1.14% actually is pretty good. And the quality of that portfolio today is even higher than that. And I'd expect that actual default rate to come down over time. Are there other risks to consider? So when we're thinking about credit risk, the sorts of things that we think about, and these are just purely examples and certainly not extensive, it's just some things that we might consider. So where's the location of the property that we're going to be secured against? The risk of being able to sell that property if it's in Gore might be different to if that property is in one of our metropolitan locations, for example. The number of buyers in Gore is likely to be less than the potential pool of buyers in a larger centre. Another example might be, is the property a luxury property? So is it the upper end of the price kind of bracket? If it is, that's going to make it a whole lot harder to sell. And we also see more volatility in prices, house prices, that is, for luxury property. So if we were writing a loan on luxury property, which we don't do very often, we're more likely to do that at a lower LVR to help manage that loss given default risk that we talked about earlier. We also look at how strong is the financial position of the borrower. So, a stronger borrower with a better net asset position and better income is likely to be a stronger risk than someone who doesn't have those things in their favour. We also then, in the case of construction projects, we'll try and understand all the various risks that go into construction. And, I could do a whole webinar on that for an hour, and we would have only scratched the surface around construction risk. That's everything from what are the geotechnical risks to what are the exit risks of being able to sell the property once they're built. All those sorts of things come into play. Alongside those risks around alongside those credit risks, there are other types of risks of investing. So you've got macroeconomic risks. What happens, for example, if the unemployment rate in New Zealand goes from where it is today at somewhere over 5%, perhaps to 10%? We get a much more severe recession come through for some reason. Heaven forbid we get to Ireland post-GFC at 14.5%. So, there's risks there. Borrowers may, if they're relying on their income to pay their loan, that could be quite problematic. You have cybersecurity risk. There's liquidity risk or withdrawal risk, as I've noted it on the slide here. That is the risk related to how quickly you can get your money back in the event that you need it. Okay, and so that's not today's discussion, but liquidity or withdrawal risk is something to consider. How quickly can I get my money back? You also have interest rate risk, so the chance that interest rates will vary up and down. We're in a falling interest rate cycle, and we've got a rate change taking effect at the moment, so interest rates are lower. So you've got some interest rate risk there. You've also got concentration risk. So are you, if this is your life savings that you're investing across, maybe a handful of different players in the market, are they all invested in one thing? So let's say you've invested some money with Squirrel, you might have invested some money with First Mortgage Trust. If it's all residential property or commercial property or industrial property and debt related to those that you've invested in, actually your concentration risk is quite high. Despite the fact that it might be relatively safe type of lending or lower risk type lending, actually concentration risk is still high. So if you read most books, diversification is important. So concentration risk is something to keep an eye on. That gives you an overview of some of the other credit type risks that we consider and some of the wider investing risks that we have. So as a summary for part 2, remember this was about how Squirrel helps manage that credit risk on behalf of our investors. We have 3 layers of credit risk protection in place. So layer 1 was we're going to assess the borrower and make sure that they're worthy of the loan that we're going to provide them. No different to the way that a bank operates. Second thing we're going to do is we're going to take security by way of typically a first mortgage for most of the lending that we do. And we're going to lend at an LVR, loan to value ratio, that's appropriate to the situation of the borrower. So typically higher risk will mean a lower loan to value ratio that we lend at. And then that third layer is with Squirrel, you've got that unique protection that we offer of the reserve funds. Okay, so those are those 3 core things that we do to help try and manage that credit risk for you, help protect your capital and deliver a regular, reliable return. The reserve funds, how do they get money into them? So part of each borrower's loan repayment is diverted to the reserve fund. So that's how the reserve funds get money and help manage that credit risk for our investors. You get the diversification benefits of when you invest with us of the whole portfolio via those reserve funds. Okay, so you're not investing into individual loans. You get the benefit of that whole pool of loans and what they do, which is a really positive thing. If I go back to that GFC period, some of the finance companies that fell over through that period, they might have lent 30 million on 3 different property developments by way of an example. If any one of those 3 fell over, the whole thing collapsed. At Squirrel, we have lots of active loans. So in our construction loan portfolio, for example, we've got about 220 active loans. Lots of smaller ones, that creates diversification. We have a huge amount of information on our website, transparently describing to you the type of credit risk that we're taking and how we're managing that and how the reserve fund's performing. So if you head to the Save and Invest menu on our website, look for the View Performance page, you'll find some of the information that I've described to you here today. Last but not least, we plan for tail risk. So hopefully we've demonstrated that with some of the data that I've shown you in the second part of the presentation about how we manage those risks, expecting that things are going to go bad one day, because inevitably they do. So that's the risk we really worry about and try to manage too. We're on to Q&A time, where you can ask me anything. Also, if you have feedback on the session, you can email me on dave squirrel.co.nz. Okay, so love to have your feedback. Let me know what you thought. Was it too dense for you? Was it about right? Did you feel like you learned something? I'd love to hear what you thought about what we've presented today. I'll thank you for your time and attention. And now I will move right on into Q&A time. I've seen some questions starting to be jotted down here. First one, there was apparently a Radio New Zealand article today around Centrix, the most recent Centrix report. So Centrix are a credit ratings agency in New Zealand, one of kind of two main ones, being Equifax, the other one. And they said the number of people who are behind on their mortgages is at an 8-year high. Statistically, and owing to Squirrel's due diligence process, how does this figure compare with the existing portfolio? Also, is this the same picture with construction at all? All right, so a bit to unpack there. So what you see with Centrix data, they take data from around 80 different lenders, and that includes utilities. So, Spark and power companies and people like that, or organizations like that. And so they have a wealth of information. Virtually all of, or as I understand it, all of the banks contribute to Centrix, and many other lenders as well. So they've got data going back over a long period of time. And what you see in the mortgages data, is, and I think I've shared this in webinars in the past, is that there's a seasonal peak, sort of January, February, March each year with arrears. Okay, so what Centrix is saying is that the number of people who are behind, so they're in arrears, so they missed a payment or they've missed a few payments, is the highest it's been for 8 years. So through the COVID period, that was a bit of an anomaly where actually the data kind of went a bit haywire. But if you look back prior to 2020, there's a seasonal peak that occurs sort of January, February, March each year, and then the numbers drop back. Where we are today is we're at that seasonal peak. The numbers are quite high. Clearly, the unemployment rate's been trending upwards, and unemployment for home loans is a really important metric, because if you don't have an income, it's pretty hard to pay your loan, right? And you'll exhaust your savings relatively quickly if you've got big home loan payments to meet. So if you look at that vanilla home loan market, then we're seeing arrears rates rise. Does that mean that that default rates are rising? Well, actually not yet. So while arrears are high, people often, and the vast majority of time, they actually catch up on their on those missed payments, or they work something out with the bank and reset their the term on their loan to bring repayments down a bit. But there's lots of ways that the banks are really helpful in actually helping their customers work through these challenging situations. So I think if you go back to the table that I showed, graph that I showed of the New Zealand defaults, remember, so arrears isn't defaults. I'm going to take you back to this page here, graph on the right-hand side. This is the actual defaults where losses have occurred. So the actual dollar value of losses that have occurred for the calendar year 2024, remember we're in a reasonably deep recession during the course of the year, was actually still pretty muted. How will that play out this year? I think there's still a bit more pain to flow through the economy before things start coming a little better towards the end of the year. So, we might see a higher default rate in calendar year 2025. All right, so arrears are up. So if I now translate that for Squirrel, arrears in our portfolio, so home loans, I don't believe there's any loans in arrears or over term. And with our construction loans, there always seems to be a handful over term. And we have one that's in default at the moment, which we've gone to mortgagee sale and are finishing off at present. I think that will close out before the end of March. And there's likely to be a loss on that particular one of about 100,000. Reserve fund's got 3.1 million in it, so reserve fund will manage that quite nicely. So that's when I said we've had 3 defaults, that's one that's live right now. Includes one that's live right now. So Squirrel's experience is actually, arrears and overterm loans occur. To date, we've had 3 written off out of the 800 odd that were written. So we think that shows that there's a pretty good track record there. And the reserve funds are well placed to manage that credit risk in the portfolio. All right, that was a very long answer to the first question. Let's see if I can speed up through the remainder of them. Thank you for that excellent question. Promise that one wasn't placed there by me either. Darius, sorry. Where does gold and silver fit into the debt risk spectrum? Yeah, good point. So gold tends to have a strong store of value. That's why you see particularly governments holding good, high levels of gold in different ways, shapes and forms. So it tends to be at the lower risk end of the spectrum based on history. But what's the underlying value of that gold and silver? So let's say the price collapses. Can you still do something with that gold and silver? Well, yeah, you can. So precious metals is we'll call it a category of investing. Gold particularly seems to have been a good store of value, history tells us, but that doesn't mean it always will be. There's always risk with that. Darius, I hope that answers the question. We could probably do another whole 101 session just on that one in its own right. Next question. All right. Jaron, will Squirrel managed funds be protected by the new government deposit guarantee scheme when it comes in? If so, any idea when this added protection will come into force? All right. So let's start with what the deposit compensation scheme is. So the Reserve Bank is issuing a deposit compensation scheme. Banks and non-bank deposit takers can choose to join that scheme, and they will pay a fee to the Reserve Bank to capitalise effectively an insurance fund that will step in should a lender who is covered by the deposit compensation scheme end up being in default with their investors. Okay, so that's what the scheme is. That scheme is expected to go live later in 2025. I don't think the Reserve Bank's given us an exact date of that. At this stage, there are about 30 banks and non-bank deposit takers involved in that, or expecting to be involved in that scheme. And their credit risk profiles go from AA- with some of the banks out to a lot higher risk with some of the finance companies or non-bank deposit takers that you see in that portfolio. And if you go and have a look on the Reserve Bank website, there's extensive coverage of what they've looked at and the amount of risk that sits inside some of those organizations. Okay, second part of the question, will Squirrel be involved in that scheme? And the answer is no. So why is that? Well, first of all, we're not a non-bank deposit taker. So we're regulated by the Financial Markets Authority for our managed funds and for our term investments. So by nature, by regulator, we can't actually join the join the deposit compensation scheme. In order for that to happen, we would have to move to a non-bank deposit taker license. At this stage, we don't plan to do that. That may change at some point in the future, but for what I know, if I peer into my crystal ball, I wouldn't expect that to happen. So what does that mean then for Squirrel? So for our managed funds and term investments, you're not covered by the deposit compensation scheme. It's the belt and braces of those 3 things that I talked about, which help manage the credit risk that you're taking when you invest with us. So that's, first of all, we will assess the borrowers. Number 2, we're taking that residential mortgage as security and writing an appropriate LVR, and we have the reserve funds in place. Okay, so that's how we aim to protect our investors. There is one caveat to all of what I just said, which around Squirrel, which is money in the on-call account will be covered under the deposit compensation scheme. If you think back, that money is held on trust for investors at major New Zealand banks. As a consequence of that, the money in the on-call account will be covered. The money in term investments and Squirrel managed funds will not be covered. All right. Ooh, that was another long answer to that one. Thanks, Sharon. If there are any follow-up questions, don't be afraid to ask them. Next question from Jared. Suppose Squirrel was to cease operating for whatever reason, what happens to the reserve funds? Would they be distributed to investors? The simple answer is no, Jared. That would be really difficult and would be unfair to all of the investors that effectively had invested with us since day one. If you go and read our trust deed, then what would happen? So let's say Squirrel ceases operating for whatever reason. The liquidator would come in and wind down the loan portfolio. So either loans will come to an end over a period of time, they reach the natural maturity, or the loans could get refinanced out. Once all of the loans were gone for each of the portfolios, any money that was left in the reserve funds at that point actually goes off to Starship. Okay, so they've been donated from a charitable perspective at that point. Key thing is that can't happen to a reserve fund until such time as all of those portfolios have wound their way down. Great question. Thanks, Jared. Question from Alan. When I am investing in an individual loan, and when am I investing in a portfolio? All right. That's a tricky but good question. Thanks, Alan. So if you invest with Squirrel's term investments, when you make an investment, that will be tagged against an individual loan or loans. However, you get the benefit of that whole portfolio via the reserve fund. So let's say, there's 200 loans, active loans in our construction loan portfolio. When you invest $100,000, that all goes against one loan. So there's, feasible scenario. At that point, you'd say, oh, but hang on a minute, I've got all of that money just in one loan. Well, if that loan happens to go bad, don't forget you've got the benefit of that construction loan reserve fund, which all of the construction loans are contributing into. So your risk that you're taking is portfolio risk, even though your individual investment or investments are tagged against an individual loan. Okay, hopefully I did an okay job of explaining that one for you, Alan. Key thing to remember is when you invest with Squirrel, regardless of whether it's via the managed fund or via our term investments, is that you are investing at a portfolio risk level. This looks like a long one from Nigel. Righto. Recently joined Squirrel. Been surprised by one thing, which I've seen my new term investments, a massive variation in individual loan amounts. I think my smallest construction loan balance is just over 100, while at the other end of the spectrum, I have two that are in 6 figures. Sorry, I'm just reading this and I'll try and summarize. Okay, I think this tags nicely on to the question from before, Nigel. And what you're saying is you're investing a reasonable amount of money with Squirrel, but you're seeing lots of different sized investments that you hold. Okay, so here's how that plays out. When you invest, you place an order. So let's say you've placed an order for, I'll just use 100,000 just to keep things simple. That order now is in the queue. When you reach the front of the queue, you start getting tagged against investments. And those investments could be Squirrel selling a new loan. So let's say we've written a loan for $1 million. You're now at the front of the queue. We make that loan for sale. You've got 100,000. So you're going to have 100,000 invested in that one particular loan. Okay, so that's scenario number one. Scenario number two is actually for people selling their investments. Let's say Squirrel's not selling one, but we have the secondary markets working as it does. And we've got individuals who may have invested $100, may have invested $1,000, may have invested $7,212. They're selling their investments. So because you're at the front of the queue with your 100,000, each of those smaller amounts of investments will drop in and match to your 100,000. So when you invest, that means you could end up with one investment for 100,000, or you might end up with 40 different investments of varying sizes. The minimum in theory is $100, although there's the occasional situation where that amount can be lower. But in general, the lowest amount would be $100. All right. Key to all of that though, so you might end up with a whole bunch of different investments with your $100,000. However, you are investing with the benefit of that whole portfolio. Okay, and that's the reserve funds doing their thing to create the diversification for you and backing all of the loans in that portfolio. I think I've answered that question, Nigel. Don't be afraid to give us a follow-up. All right, Darius, does the reserve fund for each portfolio remain circled to that portfolio? The answer to that is yes. Okay, so that means if you're investing in personal loans, you have the benefit of the personal loan reserve fund. If you're investing in home loans, you have the benefit of the home loan reserve fund. We don't cross those pools. And the reason for that is you could, if we crossed or made all of those pools just one pool backing all of the loans and all of the portfolios, at that point then every investor, if you were logical, would take the highest amount of risk that they could. To try and generate the highest return, because you've got a whole lot of people that are accepting a lower return for the same risk, because if it was only just one reserve fund backing the whole of the portfolio. That's not the way we do things. So we kind of quarantine. If you are a more conservative investor and wanting to invest in lower risk things, you shouldn't be sponsoring those investors that are taking more risk and investing in higher risk types of loans or investment pools, if that makes sense. Thank you for that question. These are brilliant questions today, I might add, so thank you. All right, question from Steve. So how many construction loans are currently active and what is the average duration? So I'm going to go from memory here and say there's about 220 active loans in that portfolio. And that number will be, I'll call it roughly right, Steve. It's less than 250 and more than 200. So I'm going to say 220, around about that. And active duration of the loans. So when we write a new loan, the vast majority of loans in that construction portfolio are written for 12 to 15 months. There's the occasional ones that'll be written for shorter amounts of time. So sometimes there's a loan that's specific to GST in relation to a property purchase. Those loans often are written for about 4 months. And there are other, you get other random bits and pieces in there. But the vast majority are in that 12 to 15 month zone. Thanks for that question, Steve. And looks like we've got a follow-up here from Steve. And this is the last one that I've got listed. So if there are other questions, please start typing now. All right, personal loans appear to have totally dried up. Are you going to actively promote these and make them a greater ratio of funds? So Steve, one of the challenges we've had is that we struggle to originate high quality loans in that personal loan category. You're 100% right that there's not many of them feeding through. And I've talked about that actively in our investor updates and on previous webinars. We're reviewing that portfolio of whether we want to continue offering that personal loans. We don't have an answer on that yet, but it's something that we're working on. Because we know it doesn't make sense for investors to have money sitting idle or earning on call for long periods of time to try and get invested. You will get invested a whole heap faster if you pop those investments into the home loans or construction loans or via the managed fund rather than investing in personal loans. To activate and try and drive high quality personal loans is quite hard. Would be fair to say. We've tried various things at different times in the past, and we haven't really had the success that we might have hoped for. So we are actively reviewing it. We don't have any answers today, but I expect you'll see answers over the next 3 or 4 months once we've figured our way through that. Thanks for that question, Steve, and very pertinent. Has Squirrel considered reverse mortgages to compete with Heartland? Righto. There's a short answer and a long answer. I'll start with the short answer, which is yes, and we are not going there. The long answer is reverse mortgages have a really unusual liquidity profile because you don't know how long that loan is going to last. And if Squirrel was to write it, that means in the way that we operate today, our investors would have to be considering locking in their money for a 20-year term because, the people may live for that long in that house. I don't see many investors wanting to take us up on that offer, if I'm honest. And so at this point, we won't be offering reverse mortgages because we don't think it fits a good liquidity profile for our investors. And I can't see very many people wanting to take that up. Particularly given, even if there was a secondary market available, if things didn't go well, that money just is locked up for such a long time. We don't think it makes sense for our investors. So pretty upfront, honest answer on that one, which is no, we won't be offering those or looking to compete with Heartland. If you want a real case study of that, if you look at the reverse mortgage providers that existed or that set up shop just before the GFC, none of them made it through. And it all comes down to liquidity and funding. So yeah, some valuable lessons learned there at a market level. Thank you for that question. This one looks like a comment, which is great work on the app features. Loving it. The improvements have been useful and definitely evaluate. Keep it up. All right. So we have a really big change planned for later in the year, which I'm really excited about. I wish we could deliver it faster, which is going to unlock all sorts of benefits for you. So that's something that's been in the works for a while. We've tested it with quite a range of customers. We're really excited about it. And I won't talk more about it because it's still quite a wee way away. It's quite a big build for us, but thank you for the feedback, Jared. Really appreciate it. Question from Sally. Thanks for a great presentation. Is Squirrel involved in the real estate at Yelsa Connect, unless you consider this irrelevant to today's topic? Squirrel has, I'll say, supported Yelsa in getting themselves up and operating. We've offered the Yelsa service or made the Yelsa service known to particularly our mortgage-based customers. So you might know that Squirrel also has a mortgage advice service. We have let that database of customers know about Yelsa. If you want to check it out, the spelling is YELSA. The Yelsa app is a different way of thinking about real estate transactions if you're buying or selling. So that's what it's about. So feel free to go and have a look there. Thank you, Sally, for that question. Next question. When you say construction loans, do you mean you lend to building companies or individuals building something like a house? All right. So for Squirrel's construction loans, we are lending typically to a builder or a property developer. The market that we typically target is small development. So that could be a single house build or 3 to 4 townhouses. That would be our typical bread and butter situation. We might also have a subdivision. So, an investor might buy a property, subdivide it, then build a house down the back, then sell one or both of those properties. So those are the types of things that we typically have in our construction loan portfolio. We tend not to lend to large developers. So people, or developers who might be building 10, 20, 50 properties. That's not our cup of tea. The credit risk associated with larger developments is significantly higher than the credit risk at that smaller end of the scale. So is there credit risk? Yes, absolutely there is in what we do. And I think I've tried to demonstrate that to you today. We tend to stay at that small end of that development space. So as I said, so a single house build or perhaps 3 or 4 townhouses would be our bread and butter. We don't get into that large scale stuff. We think that is pretty high risk in the scheme of things, and we don't think that's appropriate for most retail mums and dad investors to get involved in because those risks are quite high. Does the reserve fund earn its own income like interest? If so, what does it earn and where does that income go? How is it used? Great question. I don't think I've ever had this one before in one of our webinars, so thanks for asking. Yes, the reserve fund money, so I mentioned before the construction loan reserve fund's got $3.1 million in it. From memory, the home loan reserve fund has about just under 400,000 in it. And our personal loan reserve fund has about 1.2 million in it. So that gives you a sense of the size of those reserve funds. That money is literally sitting in bank accounts with one of New Zealand's main banks, and it earns interest. That interest just stays inside those reserve funds. It doesn't go anywhere else. It just sits in that reserve fund and contributes to investors' coverage that they have via that reserve fund. Okay, so the reserve funds are earning interest, and that money just literally lives in the reserve fund. Hopefully that answers your question there. Thank you for that one. Question from Nicholas. What happens to a credit score if you got a bad credit rating? In New Zealand, there are two main credit rating agencies. So Centrix is one, and the other is known as Equifax. I've gone through a few names at different times. For individuals and for businesses, typically you will have a credit score if you've had credit at some stage, and that could be everything from having utility. So if you've got like electricity or mobile phone in your name on a contract, then chances are you're going to have a credit score along the way, particularly if you've had some lending. That credit score will go up and down depending on how good you are at managing your day-to-day payments to those providers, whether it's a loan or a utility. If you have a bad credit rating, and I wonder if this is where the question was going with Nicholas, Squirrel typically won't lend to you. So there are other lenders in the New Zealand market in that non-bank space who will lend to people with bad credit histories. Squirrel, that's not a market we want to touch. There are other niches that we're more interested in, where typically people do have stronger credit scores. Feel free to ask a follow-up question on that one, Nicholas. Thank you. Question from Bruce. Are you able to confirm the monthly income investment is covered by the reserve funds? Great question, Bruce. The answer is yes. So home loans and construction loans that are in the monthly income fund are covered by the home loan reserve fund and the construction loan reserve fund respectively. So if the underlying investment that the fund has made is into a home loan, that will be covered by the home loan reserve fund. If the investment is into a construction loan, it will be covered by the construction loan reserve fund. So yes, all of the loans in the monthly income fund have the coverage offered by Squirrel's reserve funds. Thanks, Bruce. Next question, is Squirrel expecting any impacts from a changing US market conditions on the domestic property market? That's hard to say. I guess what we've seen is, interest rates risk is an important one to consider. One of the things we've seen is the expectations for inflation in the US have started to rise again, and we've seen those longer term fixed rates start to stay up. That probably means while the Reserve Bank control that those very short term interest rates, they can't control those longer term rates. So I think we're going to see pretty sticky longer term interest rates in New Zealand. But those short ones I expect will continue to come down. The Reserve Bank is still expecting to pass on another 0.75% in cuts during the course of this year. Some could argue that they need to go further, need to go faster. Some will say, no, actually, there's a good track. If you've got a crystal ball, feel free to have a look and let me know what the outcome is. I'd love to know. Other things around the US, well, the US is one of the largest economies in the world. So if the US catches a cold, so to speak, the impact of that will spread around the world in different ways, shapes, and forms. As we saw during the GFC, so you think of all those US loans that went bad, they'd been parceled up into investments that were held by investment houses around the world. And so the US had an implosion in its lending markets, driven primarily in the residential market from some pretty poor lending activity that was going on, including some fraud. And that spread itself around the world in quite a major way for those of you who are old enough to remember having lived through the global financial crisis, 2008, 9, 10, during that period. Question from Beth. How long generally does it take to fill an investment order for the different levels of investment? All right, so we have 3 investment classes for those that are investing via our term investments. Home loan and construction loan term investments, typically your investment order will be filled inside 2 weeks and often much faster than that. So that amount of time will vary depending on how many settlements we have going on at any given moment. For example, at the end of last week, so Friday the 28th of February in New Zealand, we settled lots of loans and we cleaned out the whole of the market. So all of the orders that were there were all cleaned up pretty much. We've got more loans settling this week, so I'd expect if you've got money in those queues at the moment, chances are you'll see it filled during the course of this week, maybe into early next week. So typically you can expect less than 2 weeks to have a term investment order filled. On the other hand, if you invest via the monthly income fund, then you're just invested once you make your investment. That investment typically takes 24 to 48 hours for it to land in the fund properly, but at that point you are invested. Okay, so that's the other way to think about that. Beth, thank you for that question. Question from Dean. How do you see the coming government insurance fund impacting Squirrel? All right, thanks, Dean. I had this question this morning as well. It's a good one. The Deposit Compensation Scheme is the official name of the Reserve Bank of New Zealand scheme that they're introducing to cover up to $100,000 of retail deposits. So, typical mum and dad type investors who are holding money at banks, you get up to $100,000 coverage with each bank. Okay, so let's say you've got a $500,000 nest egg. If you spread that around 5 different banks or non-bank deposit takers, you will be covered for all 500,000 of it. If you hold that 500,000 with just one bank, you will only have $100,000 covered by that bank. Okay, so that's what the scheme is. And if that bank happens to fall over, so to speak, then that fund that's managed by the Reserve Bank will pay out at that point. Okay, so that's what the Deposit Compensation Scheme is. Will Squirrel join that scheme? The answer is yes and no. So 2 parts to the answer. The yes part of the answer is money that's held in the on-call account. Remember that we only store that in bank accounts with New Zealand main banks. So money that's in the Squirrel on-call account will be covered under that bank's scheme. Okay, so if you're holding money in there, then it's covered under the scheme. If you and there's lots of rules sitting in behind that, but in essence, you have coverage as though you are holding the money with that bank. We're holding that money on trust for you at those banks. The no part of the answer, so the second part of the answer, if you invest in Squirrel's monthly income fund or in our term investments, you won't be covered by that deposit compensation scheme. The reason for it is, in order for that scheme to apply to Squirrel, we would have to become either a bank or a non-bank deposit taker. In the foreseeable future, there is no intention for Squirrel to do that. So Squirrel, if you're investing with us via our term investments or our managed fund, then you won't have coverage under that deposit compensation scheme. As we've talked about during the course of this webinar, though, I've talked about the things that we do to manage risk for you. Okay, so that is, those 3 primary things of assessing the borrowers, taking security and lending at an appropriate LVR for the situation, and then having those reserve funds in place. So that's how we manage that credit risk for you, rather than joining that deposit compensation scheme, which would also require us to change the type of license that we have. Thanks for that question, Dean. Long answer to that one. Question from Jeff. Presume that the interest rates are higher for borrowers with Squirrel rather than big banks, therefore is the borrower base generally riskier compared to the big banks? I think that's a reasonable hypothesis there, Jeff. So the approach that we take and where Squirrel attempts to originate loans is right on the edge of what a bank would do. Often the banks have quite blunt credit policy, which means that there's niches in the market where they don't quite, you can't tick all the boxes that a bank. In my opinion, some of those times the bank should absolutely be lending because the risks are relatively low. So Squirrel's targeted its products and the niches that we lend into those spaces. Remember, home loans in New Zealand is a $360 billion market. So when you look at a niche, that niche could be billions of dollars, right? So it's not little it's not looking at pockets of a few million here and a few million there. These are pretty big niches in the scheme of things. In general, yes, our borrowers will pay more than what they would if they could get their loan from a bank. Let's put that in perspective. So for our home loans, going from memory here, our borrowers would be paying somewhere between about 7.5% and 8.5% typically. That would be, typically what they're paying. Bank floating rates, they're carded floating rates, and yes, I know not everyone pays the carded rate, are running at sort of 7 to 7.5. So there is a premium there. And that premium also feeds through to you on the investor side, right? So our goal is to produce a return that's 1 to 2% higher than a bank 1-year term deposit rate with the investment rates that we offer. So our borrowers are paying a higher rate than a bank, and that's because they won't be able to get the loan from a bank. It would be very tricky for them to do so. That doesn't mean that we're taking on lots of really risky loans in that sense. So if I give you the example of a home loan borrower, you've got, let's say, someone who's 62 years old. They own a nice property in a metropolitan location. They're sitting on a big capital gain. They want to sell and unlock that capital gain and downsize. Very typical scenario. Banks often struggle to lend in that situation, despite the fact that it's a pretty low loan to value ratio. Whereas at Squirrel, we say, actually, provided there's a clear exit plan for that borrower, i.e. they are going to sell the house, we're happy to lend to them, help them get through perhaps a reno before they sell. We might give them interest-only terms, whereas at a bank, they might be on principal and interest payments. So we give them a bit more flexibility. They pay for that flexibility, and that generates a higher return, which ultimately our investors benefit from. They're not generally high LVR loans. As I said, I think our home loan portfolio today runs at about 55 to 60%. So tends to be lots of equity in those loans. There are other lenders in the New Zealand market, non-bank deposit takers and lenders who will lend into borrowers who are taking more risk than that, or where there's higher risk involved. For our construction loans, so that was a bit about our home loans. For our construction loans, our borrowers might be paying anywhere from sort of the high 8s through to sort of 10, maybe 10.5%, sort of in that zone. But the bulk of them perhaps are around that 9% at the mark at the moment. Thanks for that question, Jeff. Hopefully that gives you a sense of that answer. Question from Jude. What sort of market conditions would make Squirrel fair for its future? All right, so we're talking about tail risk here. I think that's what you're getting at, Jude. So what are the sorts of things that we worry about and think about and make sure that we're planning for and managing to? The answer is, one, obviously a deep decline in house prices, because we talked about the importance of loan to value ratios, how that helps manage and protect our investors. So yeah, house prices dropping a lot is something that we worry about and plan for, as I talked about. We've seen, a 20-ish% drop in house prices in metropolitan locations around New Zealand over the last few years. Has that caused damage to Squirrel's lending? Well, I think you've seen from our track record that hasn't hurt us at this point. I think there's still more pain to come. I can't predict kind of how that flows through exactly. Are the reserve funds well capitalized and ready to manage those risks? I believe they are. I can't predict the future, unfortunately, Jude. So yeah, things that we think about, one would be steep house price declines. The other thing would be the unemployment rate going up. And while most of the loans that we manage, they're not necessarily tight cash flow wise, there will definitely be some, particularly in the personal loan portfolio. So higher unemployment typically will see higher default rates in personal loans and credit cards and overdrafts, that type of personal lending. Remembering if you've got, if you own a house secured or, with a loan to the bank and they've got a first mortgage security, you tend to want to make your mortgage payments, right? You don't want to lose that. You don't want to get yourself forced into a position where there's a mortgagee sale. Most borrowers will look to sell ahead of getting to the point of a mortgagee sale. Pretty rare for banks to actually go through it. Certainly happens, so please don't think I'm dismissing that as a risk. But it doesn't happen very often, as you've seen from the data in this presentation. So unemployment rates going up, that would be something we'd worry about. General recessionary type activity in the economy. those are the types of things that we particularly would worry about. Hopefully that gives you an answer there, Joe. Thank you for that question. I see that you offer a call account, which I understand is invested in one of the banks. Squirrel went bust. How is that call account protected? Thanks for that question. All right, so the money in the Squirrel on-call account is held currently with two different major banks in New Zealand. Both of them are AA- rated. There are 4 AA- rated banks in New Zealand, so you can probably guess who those 4 are, which are the 4 biggest. And we hold money with 2 of them. So the money that you put into your on-call account is split roughly evenly between those 2 banks. We hold the money on trust for you. So you haven't given the money to Squirrel in Squirrel's name, you have kept ownership of that money in your own name. So that's what it means when we say it's held on trust for you. So in the event that Squirrel goes bust, to use your terminology, a liquidator would come in, a receiver would come in, they would be able to evaluate and ensure that all of the money that's expected to be in that account or in those bank accounts is in those accounts. Once they've confirmed that, then you would be free to withdraw that money, or they would be paying it out to you. Okay, so if Squirrel falls over, actually that money is held on trust for you, and there should be no impact on that money. There may be a delay, or the impact to worry about would be that you might not be able to get at it as quickly as you do today. So if you're withdrawing money from the on-call account today, typically it's back in your bank account in about 2 hours, depending on which bank you're with and time of day and those sorts of things. In the event that Squirrel went into liquidation, then a liquidator would have to come in and you might be locked away from that money for a couple of weeks. That would be the risk to consider there. Thank you for that question. Question from Nicholas. Will cost of living go back to normal and better for all New Zealanders? Oh, there's a thorny question and a difficult one. We know we've got some sticky bits of inflation in the economy, rates, insurances, those types of things. Is that going to change anytime soon? Probably not. If you want a personal opinion now, so I'm really going off script here. Personal opinion would be that we've probably underinvested in New Zealand over the last 20 to 30 years in infrastructure, and the piper needs to be paid. So you look at the amount that's spent on the water pipes in Wellington, pretty much you can say we've underspent, and now that needs to be spent, and that money is going to come from rates, which means rates are going to continue to go up to try and make sure that there's a secure water supply in Wellington. So that's an example of where we've underinvested in infrastructure. Because I feel like I'm picking on Wellington a bit here tonight with the example that I gave earlier and now talking about their water pipes. Equally, Auckland has infrastructure deficits. And rates will continue to rise, probably at a rate faster than other things are rising, and you just can't avoid them if you're a property owner. Equally, insurances, same deal. Climate change and the risks associated with that are seen. Insurance premiums go up. Once again, if I pick on Wellington, your insurance premiums have probably gone up quite a lot in recent years based on earthquake risk, among other things. So will cost of living go back to normal? And I think the real question there is, will inflation drop back to around about 2%? Well, that's what the Reserve Bank is expecting to happen. So probably, you'd say there's a good chance, and they'll keep bashing the interest rates to make sure that happens. But there are some sticky bits of inflation in the economy that are pretty hard to avoid and are structural. Thanks for that question, Nick. There's probably a much longer answer to that somewhere out in the world. Question from Dean. Is Squirrel investigating moving into other types of lending? For now, Dean, we're going to stick to our knitting. There's plenty of room for us to continue to grow in what we do today. There are plenty of other types of lending out there. Right now, we think we know and understand residential property really well, and so that's what we're really focused on as we grow. We're still a relatively small company, and our loan book's relatively small in the scheme of things. So, let's create some relativity here. So ANZ's loan book in New Zealand, I'm going to say is around 130 billion, maybe 160 billion, somewhere in that zone. So it's a pretty big number, right? Squirrel's loan portfolio, if we add up all of the loans across all of the different types of lending that we offer, is around 270 million. Okay, so we've got a long way to go in that sense. Over time, might we offer different types of lending? Yep, we might. There are no current plans to do so. Thanks, Dean. Next question, how do you manage a situation where you have more borrower demand compared to investor funds available? All right, so on that front, Squirrel has some lending available to us from our main bank. So we have a facility that allows us room to grow our pipeline of loans. So if we go back more than 12 months ago, so back to about April, May last year, 2024, Squirrel always had more loans available than we had investor funds. That situation has turned around since about May last year, and we've seen a lot more investor growth, and we've been writing loans at about the same rate that investors have been growing on a net basis, which means that sometimes there is a bit of a wait to get invested in our home loans and construction loans, and a long wait for personal loans. But we are continuing to grow our ability to originate high quality loans and to continue to feed the demand that we see from investors. So where there is more borrower demand, Squirrel actually has lending that it can manage in its own right, hold those loans. If I speak like a retailer for a moment, we're going to hold those loans out the back in stock, and then as there is demand from investors, we'll put them on the shelves for investors to buy into in the event that there's less investor demand relative to the loans that we've written. Thank you for that question. Question from Beth, follow-up. Didn't mention personal loan take-up time. Righto, so personal loans take a long time with Squirrel to get invested into. We publish, or you'll see that when you log in, we tell you how long it's taking to get invested. The reason for that is there's lots of investor demand, and we can't originate quality loans fast enough to meet that demand. We really do focus on that quality end of the market, and we've struggled to find high quality loans. And I think there's a few things behind that. One of those is high quality personal loans through a recession become a rare commodity. Okay, so it's pretty hard to find them. Most of what we do is to homeowners. Homeowners have buckled down and haven't been borrowing a lot. They've been avoiding trying to take on more debt over the last couple of years with the recessionary times that we've had. So it can take a very long time to get invested, and that could be 6, 9 months. I haven't looked at the numbers recently, and I don't have them off the top of my head, but it could take a long time. You are highly likely to be better off investing in the home loan or the construction loan products rather than that investment, rather than the personal loan investment pool, simply because of how long it may take to get invested. So that's my clear guidance there, Beth. Thank you. Alrighty, next one. Does the dollar in the house market affect the cost of living? Go back to normal and better for all New Zealanders. New Zealand dollar falling, well, that's been a good thing for our dairy exporters, you'd have to say. So, the one really bright spot in our economy right now is in the dairy space. Seeing the prices they're achieving for the milk that we're exporting at record levels, and with a low New Zealand dollar, that means the payout going into that part of the New Zealand economy that is surrounded, what is dairy, about 60% of that agri economy, or agri and horticultural economy in New Zealand. So that's a pretty large lump, and that would be one of the brightest spots in the New Zealand economy right now, which is a good thing, particularly given it's export related. I could probably go on about that one for a long time, so I might call it quits there, but feel free to ask a more specific question on that one. Question from Dean, transfer speed to and from the on-call account is amazingly quick. You need to patent it and sell it to the Aussies. Well, funnily enough, in Australia, they have a payments platform that is real time. So if you were living in Australia, you can actually send money from yourself to your mate in about 10 to 12 seconds. So actually domestic payments in Australia can be incredibly quick and way quicker than what we have in New Zealand. I think New Zealand's payment system is pretty good. It's pretty strong, 2-hour turnaround is pretty good. Payments New Zealand is currently investigating moving to a more real-time format. I think that's still a few years away, but at that point, once that becomes ubiquitous in New Zealand, we'll be looking to jump on it and we'll add that as a service. Not today. We're really proud of what we offer. We think the turnaround times of about 2 hours end to end are pretty good. Most of that's outside our control. We can only control our side of that. Most of it's with the banks and moving money between them in order to make things available. Thank you for your feedback though, Dean. We're proud of what we've delivered. Next question, New Zealand hospitals costing a lot more money for not building the inpatients block, costing more than the government stated. Yep, you may well be right. I feel like that hospital, though, is probably getting me off topic for this seminar, so I'll leave that one there, and perhaps we can debate that one in a different forum, but thank you for the question. Question from Mark, is it better as an investor from a risk perspective to invest, say, 5,000 to 10 different loans or invest 50,000 into one loan only? All right, this comes down to a question of diversification. And you might recall as we talked earlier in the webinar about the importance of diversification and the way that the reserve funds manage that for you, Mark. So what that means is if you invest $50,000 and it happens to get tagged into just one construction loan, do you have more risk? And the answer is typically no. Your risk is the same because you have the backing of the reserve fund, which has portfolio risk. Okay, so even if the one loan you've invested in happens to have gone bad or defaulted, to use a more technical term, the reserve fund is there with the benefit of that whole portfolio feeding into it to cover any losses that might come through. As I mentioned, we don't guarantee the reserve funds. However, to date, they've done a fantastic job of managing things for investors. So actually, you don't have to try and put, tranches of $5,000 into different loans in order to get diversification. You can simply invest your $50,000 into one particular investment portfolio and know that you've got the diversification of that whole portfolio via the reserve funds. Hopefully that helps you there, Mark. Thank you for that one, and a great question. Question from Dean, would you consider including KiwiSaver in investment funds? Or would you consider collaborating with the likes of other great Kiwi companies on that front? Well, it's something we've been thinking about. We don't have a plan at this point, but we do think we have something to offer around the type of investments that we provide into the market, and something that we're thinking about with no plans at present. So if we were going to do something, it's still a wee way away. Thanks, Dean, for the question, and a worthy consideration for us as something to explore for our product development in the future. Yeah, thank you for that. Can the government get rid of KiwiSaver? Well, KiwiSaver is in legislation, so a government could decide to try and wind it up in some way, shape or form. I think that would be a pretty big mistake, if I'm honest. That would be my opinion. If you look at what's happened in Australia, so the compulsory super scheme started in the late 70s. New Zealand actually got very close to starting one in the late 70s as well. Robert Muldoon, in his wisdom, said, no, let's not do that. And I would say we would look across the ditch to Australia with envy at their super system today, and the amount of infrastructure that super system in Australia is funding for Australia is incredible. They've got trillions of dollars in there now. New Zealand, I wish we had, what's KiwiSaver today? 120 billion, give or take. Imagine if this had have actually started in the late 70s. We may well have $1 trillion in there today ourselves. That would be a fantastic outcome, I believe, for New Zealand, as a way for those superannuation funds to be long-term investors into infrastructure for New Zealand. So personal opinion, back to the question, could the government get rid of KiwiSaver? Well, they could, but it would take some pretty big kahunas to do that, I would suggest. All right, if you have feedback on this presentation, feel free to email me on dave@squirrel.co.nz. Love to hear your feedback. Appreciate those wonderful questions that you've asked. Hopefully I've given you answers that you've enjoyed hearing, and hopefully you've learned a bit about credit risk during the course of the evening. Thanks very much. We'll see you again next time.